Hello again, and welcome to another episode of the Uranium Market Minute, a regular podcast. My name is Justin Hune, and I am your host. I'm the founder and publisher of the Uranium Insider Pro Newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Nothing in this video is intended to be financial advice. I am not your financial advisor, and this is not financial advice. Please always do your own due diligence when it comes to investing and take responsibility for your own actions. Thank you so much for tuning in. Really been appreciating all of the positive comments on YouTube, on Twitter, just loving the support and really been enjoying doing these episodes for you guys. So with that said, let's jump right in again to the daily scoreboard and talk about the price of uranium, the flows and SPUT and the ETFs. So uranium, spot price of uranium, $49.50 a pound mid-market, down slightly from yesterday's 50 1/4, slipping again a little bit every day the past few days here. The Sprott Physical Uranium Trust, affectionately known as SPUT, took in $7.8 million yesterday, issuing 600,000 new trust units, purchasing 100,000 new pounds of U3O8. They closed yesterday at just above a 1% premium to NAV, barely a premium enough to allow them to continue to issue new units and take in more capital. We'll have to see if they did that today or not. Since their ATM filing on the ATM going live on the 17th of August, they have raised $425 million and acquired 10.1 million pounds of uranium. Just absolutely insane. They ended the day yesterday with 8.2 million in cash. Let's take a look at the ETFs. As I mentioned in yesterday's Uranium Market Minute and the day before, I believe, there's a slight lag in reporting, especially from URA, when it comes to whether or not they issued new shares or they had redemptions. So yesterday, this morning, URA reported that they had 530,000 redemptions, which equates to 9 million in the mandated selling of uranium equities. URNM reflected 175,000 shares of redemptions, which equals about 14.5 million in mandated selling. And I think that these redemptions from these ETFs is really what we're seeing in the markets today. The volumes are lower. There's not a lot of buying pressure, and the selling is primarily coming from these two ETFs, in my opinion. So we'll see the stocks open up and perform kind of flat throughout the day, and then kind of pull back at the end of the day when the ETFs come into the market and start selling. Based on the research that we've done the past few days, it's looking like the lag time is about 2 to 3 days in reporting, especially coming from URA. It's quite complicated the way that this works based on the flows in and out of the ETFs. But essentially, high volume selling, and when the ETF is trading at a discount to NAV is when you see redemptions, which is what we saw most likely Friday and Monday, and we're still feeling the effects of that. In my opinion, we are likely to see another couple of trading days of low volume selling, probably towards the end of the day. Something to keep in mind if you're allocating funds to the sector now, if you're adding a tranche, if you're adding your positions, or if you're just showing up into these positions. It doesn't seem like there's going to be big volume money coming into the space for the remainder of this week. I could be wrong on that, but I'd like to think that we're going to see a little bit of technical chart repair after the damage that was done on Friday and into Monday. That's just my opinion, but that's kind of what it's looking like now. The AUMs of the two ETFs now sits at 1.64 billion, 676 million for URNM, 969 million for URA. It's still a 250 million drop from the high point of last week. Not insignificant, but as we said, we expect some minimal outflows over the next several sessions. It does seem like the volumes are diminishing. The sellers are kind of losing momentum here. So I think that this type of forced selling from the ETFs is going to diminish by the time we get into the end of the week here. Let's go ahead and take a look at the charts. Starting off with URA, the largest uranium ETF in the space. The stock opened up and then sold off throughout the day, closing just up about 10 cents here. Looks like it's maintaining above that previous resistance and above this rising 20-day. All the moving averages still moving up, still very much a bullish chart overall. URNM. Similar looking chart, although I would say it looks a little bit more positive. Didn't quite get sold off down to that previous resistance that should be new support. We've got a gap to fill down here right above that previous resistance, so maybe we'll see that. And most of these stocks in the space have pulled back at least to that 20-day. I wouldn't be surprised if we see some low volume selling to kind of reset and send this stock back down a little bit lower. If we do get all the way down to this 71.22 level, in my opinion, that's a strong buy for anybody watching this. Let's take a look at Cameco. Again, a similar looking chart. We've got a gap down from Monday morning. It's likely to be filled. It almost got filled today. Again, it opened up and sold off, closing a little bit lower than the open today, negative on the day. Looking at the MACD and the RSI, we still have some ways to go on the downside when it comes to MACD. RSI kind of leveling off a little bit in the middle here. Overall, still a bullish chart. We're still seeing all of the moving averages rising, but you'll notice the diminishing volume here. The sellers are losing a little bit of momentum. Let's take a look at SPUT, Physical Uranium Trust here. Another down day, but look at the volume. The volume is drying up on this one, and noting that this volume coming into this trust is exactly what's purchasing physical. We're about to make a bearish cross here. Have to say it, I don't think this chart looks fantastic. Even though what really maintains this chart is the level of the trading relative to NAV. And right now we're just about right at NAV. So even though the technicals say, oh, we really should be pulling back and retesting either previous resistance here, or at least coming down to that 20-day, it's really the spot price holding up and the trust trading at NAV. In my opinion, if we do sell off to this 20-day while the spot price doesn't sell off in equal proportions, that'll probably be a big hammer. And I believe that buyers will show up when that trust trades at more than a few % discount to NAV, knowing that that SPUT's ultimate goal is to keep that trust as close to NAV as possible. Let's take a look at a couple of the large caps in the space. NextGen actually positive on the day. It opened negative. Oh no, I'm sorry. It opened positive, ended up positive, sold off a little bit from its high print, but we're right about at that previous resistance, right? We're pretty close there. Just right off a previous resistance. I'd expect if we see any more selling pressure to come back down to that 50-day, and that would probably be a good place to add or take a new position if you're just showing up. So overall, the sector looks like it's kind of consolidating sideways, sort of doing a bit of chart repair from the damage from last week, from Friday and Monday. Overall, the charts overall look bullish in my opinion, and the selling volume is diminishing. This is a good sign. The sellers are not super motivated here. It seems like everybody's just kind of trying to gauge where we're at right now with the absolutely insane month we had from mid-August, or the third week of August into the third week of September in terms of the spot price, volumes into the ETFs, volumes into the large caps, volumes into SPUT. It was pretty euphoric, and those sentiment, that anytime you have euphoric sentiment, it always needs a reset. That's what we're feeling now. But like I said, the volumes are diminishing here. Really quick, let's just look and see if there's any questions here that have come in through the mailbag. Let's see. FUD. FUD stands for fear, uncertainty, and doubt. And oftentimes this can be intentional by those wanting to manipulate the market for whatever reason, typically utilizing the media. We've seen a little bit of that recently, in my opinion, with the Bloomberg article about Kazatomprom and SPUT buying from Kazatomprom. Although in no way did that seem bearish to me. That's the way that the market took it. So it's possible that that was dripped in there right on Friday when we saw that big selling, when it seems to me like there were plenty of market, let's say market makers, smart money, that probably thought that things needed to cool off for a minute there. I think that the spot price got away too fast and the equities were trying to catch up, and it felt a little bit too synthetic, for lack of a better word. That's my opinion. But here's the question. How can investors in the uranium sector not fall victim to the fear and greed syndrome? All right, well, that's a really good question. We communicate often with our subscribers about volatility, and it's very difficult to not only hang on in the bull market, as I discussed yesterday in yesterday's Market Minute, episode 7, but also to hang on the upside, and to not be bumped out by any sort of FUD, fear or greed syndrome that forces investors mistakes, right? So greed, obviously, you feel that typically, unless you're a contrarian at heart, you feel that when the stocks are actually overvalued or overbought. Technically, that's when the greed comes into play, and the fear is when the stocks really sell off and there's a lot of negativity and sentiment's really low. And really, the classical value investors, you really have to kind of think in an opposite manner to your natural emotions about the market. So a couple of tips here. One, have a reasonable allocation to this sector. The volatility affects to the upside as well, right? So in a lot of ways, uranium punches above its weight when there's the sector can move so strongly and so quickly. It has an outsized effect, right? So you don't need to put your every last dollar into this sector to have a really significant impact on your portfolio. So make sure that you have an amount allocated to the sector that you're comfortable with, that will still make good gains for you, but won't destroy you if it doesn't go the way we expect it to go. That's really important. Or that doesn't really stress you out with the outsized moves to the upside and the downside. Another tip, don't use margin. We really discourage our members from using margin when it comes to trading. You don't need excess leverage. These things are already so leveraged as it is. The mining stocks are often extremely leveraged to the spot price of uranium. And so that inherent leverage is really what we're playing on. You don't want to trade uranium with borrowed funds. Just really, just classic investing in the underlying common stocks of the miners in the ETFs or even in the trusts is really where it's at without leverage. Also, options. I can't tell you how many people I've known, myself included, who have blown up accounts with short-term call options. It's really, really dangerous if you get the direction right overall, but wrong in the short term. Making short-term options bets can really blow up an account. So we never recommend that to our subscribers. We have taken positions in long-term call options in the past, and we currently have our subscribers placed in 2 different bullish vertical call spreads, which when you're buying an in-the-money call and you're selling an out-of-the-money call. And the selling of the out-of-the-money call funds the buying of the in-the-money call, and it reduces your downside risk in the short term. So if you're directionally wrong on a bullish vertical call spread, it's far, far less painful. In fact, you can have the underlying stock down substantially and still be break even on the trade with this spread. So that's something that we've recommended to our members. We've had fantastic success with both of those spread positions. And in the most recent members webinar that we did a couple of weeks back, we described thoroughly how to structure these trades. And that was really a great benefit for our members, because you get incredible leverage, which with far less risk than simply doing short-term call options. And then again, just simple diversification. We recommend 8 to 10 names in the sector. If one of them blows up due to the natural risk of investing in mining stocks, then it doesn't absolutely destroy your portfolio. Going all in on 1 or 2 companies is extremely dangerous, and you really, really have to know what you're doing and really feel confident in those trades. And while we really feel confident in all of our positions, we take a little bit more balanced approach with that diversification in those 8 to 10 names. And then again, just lastly, as much due diligence as you possibly can do on the sector to understand it thoroughly and to know what you're getting in for and know what's going to get you out. So volatility can be your friend. You can take advantage of it, but you have to really understand this investment as thoroughly as you possibly can in order to stomach all that volatility. And again, it doesn't go both ways. If you want the outsized gains, you have to have that. You have to have that volatility. That's just the way that it works. Thank you all for watching. Really appreciate the support, and we will see you tomorrow. Cheers.